Hello and welcome to Market Domination. I'm Josh Lipton, live from our NYC headquarters. Markets mixed Wednesday. Oracle's blowout revenue forecast helped lift some major indices, and investors keeping a close eye on where the Fed is headed. Trump's nominee for Fed Reserve Governor is a step closer to confirmation, and we're digging into all of those stories. Right now, there's just an hour to go until the closing bell. Look at the major averages. Your mixed Dow is down about 200 points. The S&P 500, your broad gauge, is up nearly 0.3%. Your tech-heavy NASDAQ is roughly flat here. Let's welcome our Fed correspondent, Jennifer Schonberger. We also have data and markets editor Jared Blickery to break down all the headlines. Jared, my friend, I'm going to start with you on the trading action so far.
Thank you, Josh. It is a mixed market right now, and let's take a look at the intraday price. Is in the Dow, it's down about 186 points, or down 0.4%. You can see it spent the entire day in the red so far, off of the lows. But let's take a look at the NASDAQ, which is now, it has given back all of that green that we saw earlier in the day and is now about unchanged. And the S&P 500, that is green here, but it has given back substantially a lot of its gains that we're seeing there. And we'll also take a peek at the small caps. S&P 600, that is in the red for about 14 basis points. And the bond market, guess what? We got a little reprieve yesterday on that downward slide, but it has begun. It has resumed today. We have the 10-year approaching 4%, 4.03%, down 4 basis points overnight. And then here's the 30-year. That is down 4 basis points to 4.68%. Just seemingly 2 weeks ago, it was about 5%. So that's a huge move for the longer end of the Treasury curve. Now, here's the U.S. dollar index basically flat. So we're going to move on to the sector action, where we see utilities and tech. Those are each up more than 1.6%. Arguably, that's the AI trade right there. But energy right on its heels, that's up 1.6 as well. Then you got industrials up just 0.5%. Those are all the outperformers. Then to the downside, we got consumer discretionary, healthcare, and staples. Also, you throw communication services and financials in there. Consumer discretionary leading down by about 1%, just a little bit more than that. And guess what? That is an Amazon sector that we were just talking about. That's down 3%. Apple, the day after its big iPhone reveal. Historically, Apple doesn't do that well in September, especially after that reveal. And guess what? It's down 3% today. But Nvidia's up 3%. That's the tech trade. That's what's working. And then Tesla, that is part of consumer discretionary. So that's bucking the trend. That is actually up 1%. And there's Broadcom, another chip company that is tacking on 8% today. So let's take a quick look at those semis, and we can get it is a mixed board. You count out some of the bigger ones, and you can throw Taiwan Semi in there. You got a mixed board in some of the smaller names. But I want to get to software, because Larry Ellison's Oracle, look at that, 35%. This is just today. Let's show what's happening year to date. And you can see it is up. It has basically doubled, up 95%. And that is tacking on $100 billion to Larry Ellison's net worth today alone.
All right, and from markets to the Fed, we know President Trump's Fed governor nominee may be a step closer to securing the job. Jennifer, what do we know?
That's right, Josh. The Senate Banking Committee voted earlier this morning to confirm President Trump's nominee to the Federal Reserve Board, Stephen Miron, along a party-line vote with all Democrats voting no. This sets up a vote in the full Senate likely on Monday, where Miron is expected to be confirmed, putting him in place just in time for the Fed's policy meeting, which kicks off next Tuesday. Right, he is going to be replacing Fed Governor Adriana Kugler, who stepped down in August, offering President Trump the opportunity to shape the Federal Reserve, though Miron's nomination and now his confirmation is raising questions about whether the president and Miron threaten central bank independence. Ranking member on the Senate Banking Committee, Senator Elizabeth Warren, had some very strong words for her Republican colleagues ahead of that vote this morning, saying that if you believe in independence, you should vote no.
Trump wants to make the Fed his economic scapegoat. Dr. Miron's nomination is just the next phase of President Trump's very public, months-long campaign to stack the Fed with loyalists. When Trump seizes control, Fed decisions won't be driven by data, but by Donald Trump's personal feelings. And when the Fed loses credibility, businesses and consumers stop trusting it to control inflation and prices go up.
Myron created concerns for Democrats on the committee when he testified during his confirmation hearing last Thursday that while he would act independently if confirmed to the central bank, he would not resign from his White House post as the chair of the President's Council of Economic Advisors. That prompting Democrats on the committee to send Myron a letter demanding that he resign from his White House post if confirmed to the Fed. Myron responding that he would not commit to resigning, nor would he commit to sharing any conversations he might have as a Fed governor with President Trump. Now, the Fed meeting next Tuesday and Wednesday, where investors widely expect the first rate cut for this year of 25 basis points. And Myron, who is on record in favor for rate cuts, is very much likely to vote in favor of that rate cut. And Josh, this just seems like such a sprint ahead of the FOMC meeting between Myron trying to get confirmed, between the Lisa Cook court case, and that's just all on top of the data that we're all watching ahead of this critical decision next week.
Yeah, it's all keeping you very busy, Jen. Thank you. And thank you, Jared, as well. Appreciate it. And turning now to how Fed policy and personnel may impact the investing landscape, Brian Mulberry, Zacks Investment Management Senior Client Portfolio Manager, is here right with me in studio. We also have Michael Reynolds, Glenmede VP of Investment, joining us remotely. Thank you both for being here. Brian, I'm going to start with you. Why don't we start with the economic data, Brian? August PPI, you did see that unexpected decline in inflation, Brian. You couple that with the weak jobs data. What do you think? Is the Fed cut next week? Is that just a done deal?
Well, I think mostly so. The question now becomes, is it 25 basis points or is it 50? And I think the key number coming in tomorrow is also responsible for some of the market action we're seeing kind of trailing off today, and that would be the CPI. Can we get that down meaningfully below 3% the way PPI came in today? That's going to be an interesting data point that the Fed simply can't ignore. And the biggest question is, will they start tracking the historical data again more prominently, or is it still all about the forecasting, the trend that has not yet developed, and the reason they've been pausing so much? So I think that's just an important part of the market action and the valuation we're seeing trading today.
Mike, I want to bring you in here as well. Brian brings up a good point. Listen, I've had economists on the show, Michael, recently saying, yes, a cut is a lock next week, and yes, 50 is on the table. I'm curious to get your thoughts.
Yeah, our expectation is that the Fed is not going to try to do too much this meeting. 25 basis points is our overwhelming expectation. But perhaps maybe even more important than that is the dot plot we're going to get out of that meeting, where they're going to try to give investors a little bit of a preview of what's coming for the rest of the year. Will it matter if we don't get 50 basis points, if we just get another rate cut at the next meeting and then perhaps another one through year end, 3 total? Overall, I think investors need to realize we're getting closer to neutral on interest rates. There may even start to be discussions about ending QT that can really actually end up being a decent tailwind for the economy going forward. And that's what we're expecting to hear next week.
Michael, my colleague Jen Schonberger at the top of the show was updating us on Stephen Myron. These questions that are brought up, Michael, about Fed independence, these concerns in some quarters we hear about that. I'm curious how you're thinking through that.
It doesn't seem like markets are all too concerned about this. We look at treasury markets. The 10-year yield right now is at year-to-date lows. They're just not picking up on much concern about Fed independence here. And I think a big part of that is there's a really big difference between stacking the Fed with political loyalists and bona fide economists who, based on the data, just happen to share the opinion of the administration. We'd put Stephen Myron in that latter category. He's a bona fide economist. He looks at the data and he's come to a conclusion about where rates should be. The expectation here is he's not going to be a political actor, and you would have to see the Board of Governors be stacked with multiple political actors to sort of start to tilt and sort of chip away at that Fed independence, which we just don't think is the base case outcome here.
Brian, Michael makes a good point. I mean, these concerns, you don't see much evidence of that. I don't think bubbling up in the financial markets. On that point, though, I know you saw Ken Griffin, a well-respected guy. He wrote in the Journal, I want to bounce this off you. He said, the president's strategy of publicly criticizing the Fed, suggesting the dismissal of governors, pressuring the central bank to adopt a more permissive stance toward inflation carries steep costs. He said, Brian, these actions raise inflation expectations, they increase market risk premiums, they weaken investor confidence in U.S. institutions. That was Ken Griffin arguing that in the Journal. What do you make of it?
Yeah, I think it really sparks more healthy debate. I think to Michael's point, what you have is a seasoned economist that's here to the table, and it will just simply increase the conversation. I think Larry's points are or Ken's points are well taken, but there's also an argument underneath things saying that the stickier inflation that we've seen on consumers is driven by the higher rates themselves. And we could see lower transportation costs through better vehicle financing, better housing prices through lower financing costs. So there at least needs to be that discussion had, and I think more transparently that discussion happens. The dissent is okay. I think that markets are showing that there's still confidence, even though we can disagree on the direction or the timing, but the debate is what matters. It's very important.
Michael, it's interesting. We've gotten some underwhelming economic data, but then you see risk assets move higher on rate cuts. Does that continue, or at some point could you get underwhelming economic data and the market decides, hey, that bad news is just bad news?
It's been some of the data we've been seeing out of the labor market hasn't been great, but good enough that it's a little premature to be calling for an economic downturn that has broader implications. But it's just enough, I think, to get the Fed in a rate cut mode. We look at the cracks we're seeing in the labor market. We're still seeing overall, payrolls growth, not great, but the unemployment rate at 4.3% is roughly consistent with a healthy economy. And that's a data point that's not going to get revised a couple times over the next couple months and years. Pretty reliable. Same thing we see out of jobless claims. We're not seeing anything really out of bounds there, but it's just enough that it can get the Fed to cut rates a couple times here for a little bit of insurance just in case things start to get quite a bit worse.
So, Michael, let me ask you, bottom line, given the backdrop, the environment we find ourselves in here, how do you want to be positioned in the market?
Well, overall, we're finding a lot of our investors, if they were coming into this environment at a roughly sort of neutral posture on their stock bond portfolios, we've had a really decent market run here. They're probably overweight equities to a decent extent. Given where we have valuation sitting right now, it's probably a pretty good time to be rebalancing back to that neutral posture. We don't want to be over our skis on risk here because there's still so much uncertainty as it relates to the impact of tariffs, the fiscal impulse, et cetera. But overall, I mean, we're pretty constructive. We don't think we see a recession over the next year, but don't want to be getting over exuberant here when these valuations are as extended as they are.
Brian, what do you think? Generally constructive?
Yeah, I think it's an important time to kind of barbell your risk. There's a lot of stuff happening in the middle of this market right now that isn't overwhelmingly positive when you see bankruptcies on the rise, but we also have these 10 tech stocks that are dominating earnings growth. There's a way to go out and find, I think, better valued stocks that are in this market that you can kind of balance out that overall risk portfolio. So if you look into things like financials and healthcare, you find good individual stocks that you want exposure to in your equity portfolio, in addition to obviously the 10 stocks that are dominating market growth like Oracle today.
Brian, Michael, thank you guys both. Appreciate it. We are just getting started on market domination. Coming right up, Wall Street having a big week. Our market's ripe for more firms taking their companies public. Plus, a day after Apple's big new products reveal, the tech giant is facing tough questions. We're looking at what landed and what may be amiss. And despite a tougher year, Nike may be saying just do it to a bump. We'll explain those stories and a whole lot more coming right up. It's one of the busiest weeks for initial public offerings in years. Klarna making its highly anticipated debut on the New York Stock Exchange on Wednesday and opening at $52 a share. The buy now, pay later giant headlined a wave of new offerings as companies, including StubHub and Gemini, hit their own IPO tours. Join me now for a deeper look into the IPO market. We've got Phil Hazlitt, co-founder and chief strategy officer at Equities. And Phil, it's great to see you. So let's get right to this Klarna debut. Phil, I'm curious to get your take on the debut and the investor response and reaction to Klarna, Phil, which looks relatively, more measured maybe than some of the other recent IPOs we've seen.
Yeah, well, we've all gotten really used to these 100% pops on the first day for IPOs. So maybe Klarna's outcome seems a little more muted, like you said. But I think this is really what you want to have happen as a company. You want to have a bit of an uplift on the first day. It shows that you kind of priced the offering right. And I think it shows that there is excitement for the company, maybe not at the same level of frenzy as we might have seen for something like Circle or CoreWeave or Figma. So overall, so far, so good.
I was reading, Phil, that Klarna was valued actually at $46 billion back in 2021. I'm just curious, what you make of that, Phil. Was that just 2021 and then things got a bit extended, maybe a bit overheated?
Yeah, absolutely. The ZERP environment of 2021, stimulus checks, a lot of people at home, was a huge catalyst for some companies, but it was very short-lived, right? I think we all remember Zoom stock and Peloton stock completely went through the roof. And I think Klarna got caught up in that a little bit in where they raised at, $40 billion plus valuation. One thing I'll give Klarna credit for was, 1 or 2 years later, they really took it on the chin and said, we're going to have a new funding round at, I think, a $6.7 billion valuation, right? And it takes some guts to kind of openly admit to the market that we had it wrong. We're valued a little bit lower now. But I think what we're clearly seeing in this IPO and the filings and the numbers that come with it is that Klarna has demonstrated that they have a profitable business that can grow, that can compete, and that could hopefully withstand some of the credit cycles we may have seen in the past that have hurt other fintech companies.
If I've spoken to Klarna's CEO in the past about AI and how he's leveraging that technology in his business, and I'm just curious, do you think private companies right now, do you need a compelling AI story if you're going to make a public market debut?
I think you do. And I think what I credit Klarna with doing is that they've proven that not only do they have an AI strategy, but they've executed on it, particularly in how they really right-size their operational size and cost structure. It's what actually accelerated their ability to be a profitable company so quickly after this heyday of 2021, 2022. And so I think it is a constant discussion in the boardroom of how do we bring AI into our product, either for our users to experience it or for our team to just operate in a more streamlined way, which is, I think, really where Klarna has really hit the mark on it.
So you might need a good AI story. Do you also need to be showing, Phil, consistent profitability to win over public market investors in this environment? Yeah,
absolutely, Josh. I mean, Klarna is kind of the example of probably flirting with the acceptable numbers to be a public company, right? 20 to 25% year over year growth and profitability, and at scale, right? $3 billion a year in revenue. It's probably going to get a lot of other companies excited to come out and go public. But as my wife likes to tell me about growing a mustache, just because you can doesn't mean you should, right? There are other companies that I don't think have the right numbers to come out and be publicly traded. I do think that the companies that you've talked about and referenced earlier, whether it's StubHub, or Netscope and others, probably do have those numbers, but there are dozens of other companies that are eager to get out that might not have as much success.
Yeah, wise words from your wife, Phil, wise words. Let me ask you a bigger picture. Stock market's working, we expect the Fed to start cutting. Is that why, Phil, we see this IPO window swinging open?
Yeah. An ideal scenario for IPOs is happening right now, where you've got the prospect of a rate cut. You've got very low volatility, right? You have what I would mostly consider, stable geopolitical situations relative to previous years. That typically is really the accelerant for companies to finally come out and go public. The challenge I find is that there are so many companies that have been waiting really since 2021, 2022, that there's going to be a bit of a mad rush. And so what you start to see is, with a really successful IPO like Circle or CoreWeave or Figma or even Klarna, you get more companies eager to come out, and there's going to be some balancing of how much the market can really withstand or tolerate as far as what your metrics look like, how many more dollars can go into these companies. And so it is kind of the right environment, and we're after summer, and this is kind of where you'll see it happen. Rate cuts should be more of a catalyst, but I would also say I'd expect they're mostly priced in for most companies.
Let's spin ahead too, Phil. Gemini is also on deck. We've seen a number of crypto firms deciding, hey, now is the time. What explains that trend, Phil? I mean, in part, do you think a lot of crypto companies right now think, hey, in part, we know we've got a friend in the White House. We know the regulatory landscape is shifting. What explains that theme?
Yeah, crypto's having its moment, and I'd say it's two things. One is the one you just hit at, Josh, which is there's been a very friendly administration towards crypto, and the attitude's changed really overnight. That's part one. Part two is that stable coins, so hot right now, are really the first time where I think a lot of folks that were crypto adjacent or kind of watching crypto from the sidelines said, oh, that makes a lot of sense. A way to instantly settle money rather than waiting days for my accounts to settle and to have to pay for it. I can actually see this use case and have it and see some adoption, particularly at a global scale. So the combination of those two things have allowed companies like Circle, like Gemini, to really capitalize and really be able to tell their story, right? A lot about an IPO is really telling your story to the world of why you matter. And what better time to tell the world about yourself as a crypto company than now?
Phil, great to see you and to have you on the show. Thank you.
Thank you.
And be sure to stick around. Yahoo Finance will be talking with the Klarna CEO. That's at 4:30 p.m. Eastern on the heels of his debut on the New York Stock Exchange. Well, now time for some of today's trending tickers. Zacks Investment Management's Brian Mulberry, still with me here for a look at Oracle. We're going to talk rocket companies, maybe a little Nike. We're going to start off with, of course, listen, story of the day. It's Oracle. Those shares surging after its quarterly results. The company's CEO saying its cloud revenue will skyrocket. Wall Street is upgrading the stock on the heels of that report. Brian, listen, we've both been doing this a while. That's not a move you see very often. This thing's up almost 40% in today's trade. Skyrocketing on the results. Piper's Brent Bracelin, very smart guy, friend of the show. He's overweight. He took his target to 330. He called this an outstanding quarter. He said it underscores the AI infrastructure momentum. He told his clients the transformation, he said, of Oracle from technology stalwart into a secular winner in AI infrastructure was on full display with this report. What do you think?
Absolutely. We've been here before and talked about AI monetization, and this is on full display right now for Oracle. You're talking about their backlog of orders up 77% in one quarter, could top $500 billion. That's more than the TARP bailout back in the global financial crisis. Just to put things in perspective,
which it does.
How big that number was quarter over quarter, right? You see their multi-cloud database revenue up 115% in that same period of time. These are real numbers. This is real revenue, and that's what's impacting the stock in such a positive way. You just simply can't ignore that type of growth right now.
What a move. We're going to talk a lot more about Oracle, by the way, with tech analyst Patrick Moorhead. That's coming up shortly. Meanwhile, rocket companies, let's look at that name as well, because they got a lift over at Bank of America, upgrading that name from neutral to buy. So this one, all right, they go to buy. They say this, Brian. They say, don't overthink it. Let's keep it simple. Lower rates, they say, good thing for Rocket. Company is a strong beneficiary of Fed cuts. They say will probably spur an increase in mortgages, both for purchase and refinancing. Target is 24. This one, we should know, has already rocketed up. It's up about 90% this year.
Yeah, absolutely. And if you look at longer term price targets from some other analysts, they're in the $100 range in 2 years. So there's a lot of growth out there, but they are dependent on those rate cuts. Now, they did make a strategic acquisition when they bought Mr. Cooper earlier this year. That was the biggest non-bank mortgage servicer. So now if you think about like an iPhone upgrade super cycle, if rates do go down substantially, you could see this refi, this mortgage refi super cycle that Rocket could certainly benefit from. But it's a little bit risky. If we get some hawkish tone from the Fed where we get short-term rates down but long-term rates up like what happened last September, it might not be as big a boon as some analysts think. So a cautionary tale on Rocket.
Yeah, most on the street, we should know, do have a hold on this one. They're on the sidelines, but not B of A. They moved to a buy. Finally, let's look at Nike here. That stock getting an upgrade at TD Cowen, the firm lifting its rating from hold to buy. So they're believers, Brian. They say they like the turnaround progress here. New management is executing, they emphasize. Analysts, they argue, not fully appreciating margin recovery in this story. They say their field work does suggest improvement for Nike and Jordan in footwear and apparel. Target is 85. The average target per Bloomberg on the street is around 79.
Yeah, we like the turnaround that's been going on as well. They've called it Win Now in terms of their total operational reboot. Two main lines that they've been executing on, which is in their restoring of brand loyalty, coming back to a more sports-specific strategy, bringing in more brand loyalty on that front. And then also their wholesale rebound has been really focused on bringing back some of those retailers, like Dick's Sporting Goods has done very well. And they've actually been one of the top brands selling at Urban Outfitters recently as well. So on both fronts, direct to retail as well as their wholesale products, the proof is in the numbers. So we believe that that's a stock worth buying now as well.
Yeah, Nike reports results September 30th, so mark the calendar. All right, coming up, Oracle helped make Larry Ellison an astronomically wealthy man. His net worth now hits a major milestone. Stay with us. We have that story and more when we return. Apple unveiling its iPhone 17 lineup during an event at its headquarters, including its new iPhone Air. For more, we're bringing in Yahoo Finance tech editor Dan Howley. You know, Dan, I'm of course going to wait for the full Howley review before I pull the trigger, but that iPhone Air, Dan, I'm curious.
Yeah, I mean, Josh, I got to say, you know, going into this, I was kind of a little suspect of whether or not the Air would be an interesting product. And then, I got to go hands-on with it at Apple's headquarters. And I got to say, it really is striking how incredibly thin it is. I've actually seen some folks online in the tech media press compare it to Samsung's own super thin Galaxy S25 Edge, and the iPhone is actually thinner than that even. And of course, Samsung ended up using that Edge as a platform to roll out its foldable phone, which is just a great piece of technology. So the thinking is that Apple will do the same with its own new iPhone Air. And so, I think one of the things to keep in mind is that the Air does have that one camera. It doesn't have two or three like the other phones do. So you don't get a wide angle like you would with the standard 17, and you don't get a true telephoto like you do with the Pros. Those go up now to 8x telephoto. So I think there's going to be some trade-offs, but I do think that at $9.99, a lot of people are going to want to jump on it just because the design is so different than what you've seen in iPhones past, and it truly is incredibly thin. I mean, I was holding it, comparing it to the Pros while I was there, and it just knocked my socks off to just see how thin it was. And then, outside of that, obviously, some of the bigger announcements outside of the Air, of course, were the new watches and their new hypertension detection capability, chronic high blood pressure. I myself recently was diagnosed with high blood pressure. I want to see if it's able to detect it. Hopefully not. Hopefully the meds are kicking in at some point. And then obviously the new AirPods Pro 3 with their heart rate tracking is really interesting. And between the watch and the AirPods, both having heart rate trackers, if one doesn't work as well as the other, or one's not getting as good of a reading, they'll just bounce off each other to keep going back to see which has the best reading. So you're able to constantly track. But even if you don't have a watch, you can still use the AirPods to track your exercises on the go and still get things like your heart rate, your heart rate zones. You can use it with the Apple Fitness Plus. You would still get GPS tracking with your iPhone. So it really is an interesting lineup. To me, one of the larger themes was Apple's further push into health with the hypertension detection, the heart rate tracking, and then they also improved the hearing aid capabilities of the AirPods Pro 3 with the new conversation boost. So if you're someone who's hard of hearing and you're in a loud area, it'll boost the conversation with the person that you're having versus the audio around you. That's also, by the way, coming to the AirPods Pro 2 as well as the AirPods 4 with active noise canceling. And then that hypertension detection, that's also coming to the Apple Watch Series 9 and newer, and the Apple Watch Ultra 2. So they're rolling this out across a number of products, and it just really does reinforce Apple's further push into that healthcare space.
Dan, what did you make of what they did with pricing? Because that was a big source of debate and discussion on the street heading into that event.
Yeah, I mean, there really seemed to not be too much of a push higher as far as pricing. I think it was only the Pro maybe that saw a new base price, but it's the same as the 256 would have cost you last year. They didn't do that with the standard iPhone, and the Air is the same as you would have paid for the Air, the Plus, which the Air replaces. So it doesn't feel as though there's too much in terms of price swing, which is actually a welcome development. Going into it, we thought we could see as much as $100 price increase for the Air versus the prior models. And so, it doesn't seem as though Apple's gone in that direction, despite concerns about tariffs, despite concerns generally that they haven't raised prices in quite a while. I do think that that's something that's very welcome among consumers, especially as they're looking to get people to want to go out and upgrade as soon as possible with this new Air. And I got to add, the Pros do get a new kind of styling on the back, so you'd be able to tell them apart from between the 15 and 16. There really wasn't much to identify the difference. You'd be hard pressed to be able to tell it. With the new Pros, they have a new back where the cameras are. And as I said, the cameras are much improved. So, they really did kind of massage everything across the board, getting that new design with the Air. I do think that this is probably their strongest lineup in quite some time, but we'll just have to see if, consumers are willing to go out. A lot of people still only upgrade when they need it. The one time that they do it is when there's a new design. And that's what the Air is exactly.
All right, we'll wait and see what it means for that upgrade cycle. Dan, thank you. Oracle enjoying a healthy run so far this year, and with the stock surging after its latest earnings report, we're taking a deeper dive into Oracle founder Larry Ellison's net worth. For more, we're bringing in Yahoo Finance markets and data editor Jared Blickery. Jared.
Thank you, Josh. We'll get to Ellison in a second. First, let's just marvel at the stock price increase. This is a large company. For it to be up 36% in one day off of earnings is substantial. Look at that market cap. $928 billion, closing in on that $1 trillion mark right there. And the PE ratio fluctuating around 75. So that's a huge multiple. And just real quick, here's a chart of Oracle. Let's do this year to date. And you can see it has almost doubled its stock price over this year. And now I wanted to take a look at Larry Ellison's net worth over time, most of which is tied up in Oracle stock. This chart goes back 5 years. In white, we have Ellison's net worth, which is scaled on the left axis. And then we have Oracle's stock price on the right, and you can see the point is they move very, very closely together. Lots of zigs and zags together, basically ending up at the same point. Now I want to show you a comparison with Ellison and Musk. And here is Ellison versus Elon Musk. Now in white, you can see the line here is pretty steady over the years. It just surges right at the end to become a little bit greater than Elon Musk. But guess what? Larry Ellison actually had a higher net worth going back all the way to 2020 there. And Elon Musk, although there's more volatility in the share price of Tesla, and that's really where he's getting his net worth from, you got to think that there's going to be a few lane changes and position changes here going forward. But what a huge tape for Larry Ellison. Both of these guys, by the way, closing in on $400 billion of net worth. Back to you.
All right, Jared, thank you. Well, as Oracle lifts AI hopes with its blowout revenue forecast, CEO Safra Catz highlights cloud revenue will skyrocket thanks to a big jump in bookings. Meanwhile, co-founder and chief technology officer Larry Ellison is reaping the benefits of Oracle's spotlight in the AI revolution. For a closer look at Oracle's position in the AI infrastructure leaderboard, let's get now to Patrick Moorhead, Moor Insights and Strategy, CEO and chief analyst. Patrick, it is great to see you. So let's get right to the stock move here, Patrick, which is remarkable. It's up nearly 40% in today's trade. What do you make of that move, Patrick? In your opinion, is it justified?
So first of all, it's unprecedented. I mean, you've got a very large public company to begin with. And sure, we see these pops when somebody's doing their first IPO or there's an acquisition, but a company that was worth this much last week, and then you see what they're worth today, it is unprecedented. And if you take that 400 and change billion dollar to the bank of OCI revenue at reasonable margins, yes, the stock pop does absolutely does make sense.
Let me ask you, Patrick, how are Larry Ellison and Safra Catz, how are they doing this exactly? You know, as they compete with the cloud giants, what are they bringing to the table that's different? What are their competitive advantages?
Yeah, so as we've seen, being first doesn't always mean you can't get in on it. I mean, Apple was probably the 10th person to get into smartphones, and look at where they are today. And I think when Oracle said it was going to go big into infrastructure, I think everybody did a gigantic eye roll because it looked like it would be lower margin profile than their current business, and also takes an incredible amount of capex. But what Oracle did, and only I think Larry could do, is convince the board to go all in on capex with some gigantic investments. He also came in and he just didn't say, you know, hey, we're going to copy what somebody else did. He came in with a brand new architecture to be able to make that happen in a unique and differentiated way.
In terms of where all this business is coming from, Patrick, I don't know if you saw this. The Journal is reporting that Sam Altman's OpenAI signed what sounds here like just a massive contract. They're saying $300 billion in computing power over about 5 years from Oracle. What do you make of that? I mean, that has to be one of the biggest cloud contracts ever.
It was, and yesterday after their earnings, that was my assessment, that this was likely OpenAI, some pass-through, some Microsoft, and maybe even some xAI. So I think OpenAI is a very large customer of theirs. And this is all part of this Stargate project that was discussed and announced at the White House a few months back.
Let me ask you another question. I'm sure top of mind for investors right now. They're trying to figure out, Patrick, what do you think the margin profile of Oracle Cloud could look like long term? As a tech analyst, you're modeling that out. What do you see?
Yeah, so right now, it's not necessarily about the lowest cost. So I do think OpenAI and even some of the pass-through for Microsoft and Azure comes at a very good premium. Is it 40% like AWS's businesses? Probably not, but I think it's pretty safe to say that it's 35% net operating margin. And over time, as being there with the capabilities, having the power, having the space, as those go away, I think the margin potentially reduces. But there is some value, some staying power that you have your AI applications sitting on OCI, and they're not just going to evaporate. So they wouldn't do this without a good profile, but I don't think that it's going to be industry leading because a lot of it's passed through at this point.
What about cash flow on the kind of backlog we're talking about here?
No, I mean, cash flow is absolutely incredible on something like this. And that's the story, which is what's the net cash that says this is going to be spitting out here. And I think as we get more clarity on what the margin profile is on that 400 and so billion dollar investments over multiple years, we're going to start to see that a lot more clearly. One of the things, though, I want to reinforce is that this does come down to it's less about cost, it's less about price. It's having it today. It's time to market. And some people are willing to pay a premium on there because what we're looking at is this once in a decade share shift position and dollars moving from different buckets and new dollars being created. I think this is the motivation that OpenAI has that says we have to be in front, ahead of the pack, leading everybody. We need to have that locked in to not only push away the competitors, but to get developers locked into us, to get governments and enterprises that are locked into us. And it's very hard to get out once you're locked in.
As a longtime analyst, Patrick, I'm curious, how much credit do you give to Larry Ellison specifically for this success?
Without Larry, none of this would have happened. I mean, listen, it takes a village, and the team is excellent on the OCI side. Safra is making it happen as well. But Larry's one of the last founder CEOs that are out there. And as we've seen, him and people like Michael Dell and even Mark Benioff are able to do things inside of companies that others can't. Given that Larry owns so much of Oracle, he has extra sway as you would expect there. But he had to go in and pitch a software company, do the pitch on going bigger in infrastructure than almost any other company on the planet. And they could be easily a top 4 hyperscaler when the smoke has cleared here, maybe even number 3 out there, which if you'd have asked somebody 3 years ago, they would have said there's a 0% chance that would have been Oracle.
Final question, Patrick. Listen, the stock is surging. It's a great day for Oracle investors. It's a great day for Oracle bulls. It's a great day for Larry Ellison and Safra Catz. But we should also, of course, keep in mind the risks. As you think about the risks for the long-term investor for Oracle, what would they be?
Well, I think the first thing is let's look at the this is more of a macro risk, which is how long does this build out continue? I feel very comfortable that the next 18 months or 24 months, this is going to look good. I feel very comfortable with the database as a service. I mean, Larry's database won, and that database and his infrastructure is actually being put into the top hyperscalers that are out there. I think we should keep our eyes on margins. I don't know what the margins, I know what they should be. I have a hunch, which we just talked about, which they should be, but what are they actually going to be, and how is that bake into the forecast? I would like to see Oracle doing more with agents. They have a very strong enterprise SaaS platforms. In fact, they have two. One that's on-prem, actually two, one for high-end enterprise and one for more of the mid-market. I'd like to see more about how they are addressing agentic workflows that cut across horizontally. And quite frankly, this is the biggest risk with companies right now, like Salesforce, like Adobe, like Workday, that they're just getting hammered out there in the marketplace right now.
With the stock up 37% right now. Patrick, as always, my friend, great to see you. Thank you.
Thanks.
Coming up, sky-high ambitions for Joby. Stick with us. We have that story and a whole lot more when we return. Electric air taxi operator Joby announcing it will bring Blade's air mobility services to the Uber app. Yahoo Finance's Praz Submaranian join us now with more. Praz.
Yeah, Josh, how you doing, man? So yeah, Joby and Blade teaming up here with Uber. As you know, Joby, the eVTOL or electric vehicle takeoff and landing operator, they bought Blade's passenger operations last month. So starting next year, Uber users can book through the traditional app. They can book helicopters and seaplanes. These are traditional helicopters and seaplanes on the Blade network, for instance, from New York City to the Hamptons. It's not the first time that Joby and Uber have collaborated in the past. And a few years ago, Joby bought Uber's Elevate robo-taxi or air taxi business several years ago, and now they're sort of developing it with themselves. So Joby wants to be operating these electric air taxis soon, the next iteration, a business that they see potentially growing sevenfold in the next 10 years.
Do we know, Praz, how much this could cost?
You know, we were looking at, Josh and I, we were talking about this, we were looking at the fact that currently right now, a Blade helicopter, one seat on a Blade helicopter to the Hamptons from New York City costs around $795, right? That's sort of the going rate right now for one way, one seat. You can also book a whole helicopter if you want. But so I personally think that price is going to be coming down, especially if they're able to transition to the electric vertical takeoff and landing copters, if you will, because those are a lot cheaper to operate. That's the goal anyway for this partnership.
And when it comes to air taxis, Praz, I get the excitement and the opportunity. I am curious, do we know broad strokes how regulators feel about the opportunity? I mean, where the FAA, where they come down on this, how they're thinking through it?
You know, it's funny because we've been hearing about these things for a long time, and we would have thought they would have been here by now. I think there was Uber many years ago thought by 2023 they would see these electric takeoff and landing vehicles. But the news as of today, or as of earlier this year, is Joby said that the last month they had their first air taxi successfully operate between two airports in FAA-controlled airspace between California's Marina Airport and Monterey Airport. So they actually did a flight between those two places and landed successfully within other airspace. Joby said that it began final assembly of its first aircraft intended for type inspection authorization, which is a FAA sort of certification is to see if an actual plane is airworthy. And then that they think that those tests will begin early next year. And then going forward, they want to be operating in LA and New York City. Not sure how long that's going to take, but maybe a year or two.
Praz, you know, when we think about the market right now, all the excitement, who would you consider like a Joby rival? Who's a competitor here?
Wow. There are a few. So right now, Joby is sort of like the leader with they partner with Toyota of all people. They partner with Delta, and they're sort of in the driver's seat here. But there's other operators out there. The names escape me right now, but I'll have to get back to you on that. But yeah, it is a crowded space nonetheless.
Crowded, exciting, and a lot of interest. Praz, thank you, sir. Appreciate it.
Thank you.
Big banks trying to make sense of the economy. The Fed, recent mergers and acquisitions. Our senior banking reporter, David Hollerith, has his finger on the pulse of what CEOs are saying and joins us now with more. What are they saying, David? What are the themes?
Well, so Josh, I guess the two big themes that we're hearing is that one, they're giving their mid-quarter projections, and they only typically do that around their Wall Street operations. So that's investment banking and trading. And the beginning of this year, the first half really has been a phenomenal year for their trading operations, and they continue to sound pretty good for at least so far for the third quarter. So all the major banks we're hearing from, the big six, as you would put it, three of them gave guidance and it was all up. Industry standard and investment banking is also up, and so Bank of America, JP Morgan, Citigroup, they're all very positive about these operations. Now the other side of it is the economic thing, which is that generally they're saying that consumer credit and they're outside of commercial real estate, office space, their wholesale credit loans are also in pretty good shape. So they're saying actually a pretty good picture as of right now.
Big banks versus regional banks, as investors sort of think through that theme and those dynamics, how could that kind of shake out as a theme, as a trend?
Yeah, a lot of that has to do with interest rate cuts. What the analyst community continually points out is that regional banks see more of a benefit from interest rates being lower, just depending on their portfolio of loans, more commercial real estate heavy, mortgages, things like that. So regional bank stocks have been rallying since there was sort of more optimism about Fed cuts. Now, the interesting thing here is that the question is, what kind of economy are we getting once interest rates start to come down? And so that's brought a little bit more uncertainty to the equation. But you are starting to see investors sort of pivot towards regional banks as big banks right now. So,
all right. David, thank you, sir. Appreciate it.
Absolutely.
We're wrapping up today's Market Domination. Don't go anywhere. We've got you covered with all the action following the closing bell. Stay tuned for Market Domination Overtime.